Hello everyone, welcome to today's US Open live session. It is Thursday, March 28th, as the month is about to expire. We're 10 minutes before Wall Street opens as usual, and I'm your host Nikos Zabouras, Senior Financial Editorial Writer at FXCM. This is a holiday shortened week as Friday is a holiday in the US and much of Europe due to the Easter holidays. However, we have quite some significant developments. We had a hawkish stance by key Fed officials. We had a technical recession in the UK based on the fourth quarter data we got today. And of course, we have inflation on Friday from the United States. And we also see significant movements in commodities as well. So these are the main themes we will be talking about today. Before we begin, however, please read carefully the risk warnings and the disclaimers. Okay, let's get the ball rolling. We're gonna start off with Euro USD and discuss about the monetary policy dynamics between the two central banks and the recent hawkish commentary by key Fed officials. We're then gonna turn our attention to the Nasdaq 100. We're going to talk about the UK index given the country's technical recession in the fourth quarter. And then we're going to also cover a little bit two commodities, copper, which recently hit 11-month highs, and gold, which looks set for new record highs. Now, on the Euro USD front, we see it staying under pressure following the latest comments by Fed's Mr. Waller and Mrs. Cook, both of whom called for a conservative approach towards monetary easing due to the strong economy, relatively tight labor market, and persistent inflation, themes that we have covered here multiple times. At the same time, expectations for a June pivot by the ECB are rising given progress on inflation and weak economic output, um, in a theme that was highlighted by today's substantial drop in German retail sales. As you can see on the chart, the pair trades well below its 200-period EMA and breached the daily Ichimoku cloud, the lower border. And this creates risk for new 2024 lows, which are currently located at 1.0694. But sustained weakness past that level seems like a tall order at this stage. The common currency, as you can see, already reacts from the slide today. And although the ECB is a better candidate for a pivot for the reasons we mentioned earlier, it has adopted a more reserved language. Furthermore, despite the hawkish remarks by Fed officials, the US Central Bank has clearly pointed to lower rates this year and reaffirmed its projections that suggest 3 cuts. As such, we can see a rebound above the 200 period EMA, but we're cautious around larger gains that would tackle 1.1017 resistance. In any case, the policy dynamics are in flux, and this could prevent clear moves in either side. And markets now look to Friday's PCE inflation update. Of course, we have seen, as we said, some stubbornness in inflation with the CPI being higher, but now we expect the PCE, the Fed's preferred measure, which you can see on the chart, has been dropping but has lost momentum recently, and baseline forecasts are for an uptick at Friday's figures. Now let's turn to the Nasdaq 100. We're still 4 minutes before the US session begins. Once again, Wall Street is closed tomorrow due to the Good Friday. We can see that the tech-heavy index consolidates its recent record highs due to the aforementioned hawkish remarks by Fed officials, Fed voters, and a breach of the 200 period EMA remains a reasonable scenario technically, but the downside appears well protected, starting from the March lows at around 17,780. On the other hand, the tech-heavy index has largely overlooked the recent repricing around the Fed's policy path and maintains its bullish momentum, largely due to the artificial intelligence blaze that keeps on burning. And now let's change tack and talk about the UK main index, the UK 100, FXCM's CFD. As we discussed in our last session, the index closes into its record highs at 8,052 as the Bank of England appears to be getting closer to cutting rates. Inflation has cooled down substantially in February after recent stubbornness, and today's data reaffirmed the economy's perilous state as they showed a back-to-back contraction in GDP, which is the definition of a technical recession. That, of course, strengthens the case for a pivot. On the other hand, weak economy is a limited driver for any index, and inflation is not expected to return to the 2% target before 2026, despite the central bank expecting to temporarily hit that level this year. Furthermore, Mr. Haskell, an MPC member, said today that rate cuts are a long way off, speaking on Financial Times, and as such, a pull back towards the 7,900 region here in this week's lows is likely, but bigger losses have a higher degree of difficulty, and the 200 period EMA is definitely very distant at this point. Now I want to turn my focus on commodities, copper and gold. Let's start with copper, which hit 11-month highs earlier in the month, but pulls back to critical tech levels. You can see that it tests the 38% Fibonacci of the last rally and just below since the 200 period EMA. Daily closes below it would open the door for further decline towards the 76.4% Fibo. And there are also concerns around China, a key consumer and producer of copper, and especially its property sector that remains in unrest. However, as long as this key technical area is maintained. This right here. The bullish bias is maintained, and we can see higher highs towards and beyond the 4.196 mark. Furthermore, the demand supply side dynamics favor higher prices. The green energy transition and the rebound of the chip industry, largely, of course, due to the AI boom, can drive demand for the metal. At the same time, supply concerns are on the rise. Chinese smelters committed to output cuts this month, while major mines like Anglo American and First Quantum have slashed their 2024 production outlook. So at this stage, and as long as this, both due to fundamental factors and as long as this technical level is defended, this confluence of various supports, the uptrend is intact and can lead to new highs. And now let's switch over to gold, which looks set for new highs. You can see that it's closing in towards the $2,300 mark. And that is largely because the Fed has reaffirmed its projections for 3 rate cuts this year. So that weighs on the greenback, thus helping gold, which is denominated in dollars. On the other hand, however, there is a hawkish commentary that we already talked about, supports the greenback, and this can weigh on the precious metal and send it back towards the 200 period EMA, this level that you see on the screen, the black line. And as the RSI moves to overbought conditions. However, strong catalyst would be needed for daily closes below that level that would hold the upside momentum. That's pretty much it from me for today. Just a reminder, Wall Street is closed tomorrow and much of Europe due to the Easter holidays. Thank you for joining me. Have a good one.